Anyway, so here we are. This is a hugely ambitious talk. I'm going to try in an hour, hour and a half, maybe depending on how things go, to kind of try and sum up the basics of the oil and gas industries. And I suppose the first question is, okay, what's so special about oil and gas? And I guess we can all answer that to some extent. It is, of course, the biggest commodity that's traded by volume and by market price. And of course, it's the basis of our economy. When the oil price goes up, our economy growth slows down, and vice versa. It's what's got us to this very sophisticated civilization that we have now, with all its disparities and so on. It's also, of course, as we know, had a huge impact on our political history for the last 100 years. Not just the many wars that we've been involved in, but also the global north-south divide. Oil. And the dependence, the need to access oil, which has to be bought in dollars, of course, is just another structural barrier to the development of the developing countries. So there we are. It very much shapes our world. And then, of course, climate change, the new thing on the block. And of course, what the experts, what the scientists are telling us at the moment is that at least 80% of our known reserves of coal, gas and oil need to stay in the ground if we are to have any chance of staying below 2 degrees of warming from pre-industrial times. And in fact, I don't know if any of you are on the mailing list for Bill McKibben from 350.org, but of course he sent one round this week saying we cannot, and this is backed up by a lot of research, saying that we cannot afford to build any more fossil fuel infrastructure. Now, stop. So we have these the bizarre thing is we have these sort of two parallel but completely incompatible truths going on. And that's kind of what makes this so fascinating, but so worrying. If you listen to the oil industry and the conventional economists, they will say, of course, we just have to wait when solar is, has got its issues sorted out with battery storage, and when it's compatible on the market, then then it will take over from the fossil fuel industries and so on. But at the same time, the scientists are screaming at us. We cannot do this. And just in case anybody hasn't kind of understood quite where we are with that, at the moment we are in line for, of course, a 6-degree warming, 5 to 6 degree warming, according to the International Energy Agency, by 2100, at which temperature we do not live. Okay, the planet dies, as far as we're concerned. And anything over 3-4 degrees, we are talking about the end of civilization as we know it. The Paris agreements bring us very close to 3 degrees. So we don't have a lot of room for maneuver. We need to peak our emissions really by 2020 at the latest, and then cut very fast. And certainly in the OECD countries, in the industrialized countries of which we are one, we need to be cutting some estimates by 10% per year, very, very quickly. So we've got these sort of two parallel truths. And actually, I think one of the interesting things it sort of conjures up, and it's really hard to figure out how this is going to work, is exactly how our world economy, how our world politics are going to work in this new world order, which, let's be clear, all our governments have signed up to. Decarbonisation is happening. All our governments have said that is our goal. At the moment, we're committed to it by 2100. Of course, it needs to happen much faster than that. But they have all signed the death warrant for the fossil fuel industries. So, we've got to think about how is that going to work? What's the future there then? Okay. So, just to go through absolute basic figures. Okay. These are the consumptions from 2015. Just a reminder. You can see how absolutely dependent we are on the fossil fuel industries, oil, gas and coal. Oil in its pretty much monopoly position for transport. We really don't have an alternative for aeroplanes, for ships, even for cars at the moment. We've dabbled with biofuels, but haven't got too far with them for many reasons that I'm sure you know about. There's the possibility of hydrogen, there's the possibility of electrifying our vehicles, our ground vehicles. But, you know, basically, we've got to get that lot into these. And if you don't want nuclear, we've got a big, big task ahead, and we've got to allow for growth in the global south. So that is our challenge. So now this is a hugely ambitious, I realized as I was writing this talk that, you know, an introduction to the oil and gas industries in one evening is really a bit of a big chunk. So you're going to have to forgive me for the bits that I miss out. But what I'm going to do is everything at the moment revolves around the oil price. It is absolutely central. It's central to the investability of our fossil fuel industries. And so I'm going to do, and forgive me for anybody who was here last week, because this is a slight recap of some things that we covered last week. I'm going to do first a walk through the impact of shale, because we really can't. There are many stories going on with oil and gas. You can look at the Middle East, you can look at what's happening in Africa, you can look at China, whatever, Russia. But the dominant story at the moment in this industry is shale. Okay, and its impact. So I'm going to it's really kind of important to understand it, so I'm going to just do a little walk through that. And then we're going to look at the other factors that influence price, okay? Because most people think that the Brent price, the oil price, really is all to do with demand and supply, and in fact it's a lot more complicated than that, and it has a lot more to say about our economy and how it functions. So this is just a little walkthrough. I'm going to sort of talk you through really the last sort of 10, 15 years sort of history of how we've got to such a kind of crisis point. And let's be clear about it. The oil and gas industries really are in quite a difficult position at the moment, quite bizarrely, given their many strengths. But I'm just going to walk you through some of the practicalities that they face. Of course, the usual thing is, of course, the industry drills for oil. And what it comes up against is a cap of gas above that. That's the usual thing, associated gas. And it has to decide what to do with that. Now, the trouble with gas is that you can't transport it as easily as oil. You can't just pour it into a barrel, stick it on a train, or whatever. And if you're far from, if you can't easily pipeline it to a market, what do? And then, not only that, we've got more of it. We've got conventional non-associated gas. We've now started developing coal bed methane, so getting gas out of our coal beds, and then of course shale and blasting that and getting gas there. And of course, for anybody who's here in the first talk, we now have fire ice. So we have these very unstable methane deposits all around the continents, becoming more unstable as our oceans warm, a big threat. One of the potential tipping points that could change everything on our planet very quickly. The yellow dots there are where we are actually now exploiting this as a resource, as an energy resource, and so on. The red ones are where there is potential to do so. So, of course, this is the traditional thing. What have we done for decades? We have vented gas. We have just let methane go straight up into the air. And as I'm sure most of you know, methane 25 times more dangerous than carbon dioxide. So we have just shoved it straight up into the air because where it's not been practical to get it to a market. Industry did one a little bit better, started flaring it. And of course, as everybody knows, Nigeria, synonymous with flaring, 24 hours daylight and so on. In fact, actually what most people don't know is that Russia, and Russia is on the blue line there, Nigeria is the green line. Russia is by far the worst when it comes to flaring, by far the worst. This rather bad picture, it's the only one I could get, is of flares in Siberia. So, you know, they are by far the worst culprits when it comes to flaring. Anyway, of course, we're not exempt either. All those lights out in the North Sea, we're doing it too. So there we go. And we found some uses for gas. We can shove it down to help lift the petroleum or the crude oil. And we've got this sort of intermediate stuff, natural gas liquids, damp, wet gas, which we can clean and process and transport. It's quite expensive and it's difficult to handle, but it is a sort of an intermediary between oil and gas. Okay, so then everything changed around 2000. The economics and the technology came together to really make liquefied natural gas work. And this meant that we could ship gas very long distance very effectively. So this is Qatar, in fact, is the major LNG exporter at the moment, and this is one of their plants, Pearl, I think. And what happens there is that they supercool the gas to minus 162 degrees, and obviously that takes a lot of energy in itself. Then they stick it on cryogenic vessels and transport it thousands of miles. And of course, many of you will know that last week we had our first shipment in from the US of LNG shale gas. And it was shipped in this way. And that's Haverfordwest, which is one of our LNG plants where we regasify, we warm it up, get it back to room temperature, and then stick it into the grid. And on a transporter like that, it will use about 25% of its own cargo just to get any sort of distance at all, any sort of 1,000 miles. So it's an energy-intensive industry and has taken an awful lot of investment. But that all started getting going around 2000. And what it's done is open up huge new gas fields. So there's Qatar, there's North Field since 2006, and it's made every Qatari the most wealthy people in the world, of course. Iran shares the field, and Iran, of course, has been hindered by sanctions, but is now getting going on developing that field more. Australia, with all these stranded assets there's been, all these massive, great big gas deposits, where do you send them? There's been nowhere to send them, but now we've got LNG. So we've got some really big ones, Gorgon and Wheatstone just about to come on, so there's a lot more LNG about to happen. Big gas find in the eastern Mediterranean. Egypt had a big gas find last year. Off the coast of Mozambique and Tanzania, also huge gas finds. So suddenly gas, we are not short of gas, basically. And all these major investments made, and then along came shale, okay? And I don't know if anybody's read this book, I'm just going to give it a plug, because whatever you think of fracking, or if you want to understand fracking, it's a very good book for understanding the story of how these sort of small producers got out there and started going back to old fields, and they brought together the technology of horizontal drilling and fracking, so shoving down chemicals, water and sand, and fracturing open the shale, sometimes at just a millimetre wide crevices, and getting out the gas. So they got going on that, and I mean, what is quite humorous in the story, really, is humorous, I don't know, sad, whatever, is that they didn't really realise what they were doing. I mean, obviously they were all making a killing, and if anybody's seen the film The Promised Land, you'll understand some of their underhand methods of acquiring land and access to resources. But what they did, suddenly we've had a whopping great increase in gas production, and they suddenly realised that in fact they were crashing their own price. And that's what happened. So the US price just absolutely sunk. And there was no export facilities. In fact, the US was really geared up for... They were panicking because they hadn't got enough facilities for importing gas. So suddenly there was a massive turnaround. And so now, OK, gas price is right now. It's extremely low across the world. And the gas industry is pulling its rigs all over the place. But output is still sort of slow to respond. That's mainly to do with the fact that this industry... It's an industry built on cheap finance. It's been described as a Ponzi scheme. It's very productive, but not very profitable. The companies that have got involved in it have borrowed massively, and that is one of the reasons why they've had to keep drilling, whatever the price. So that's why output has been quite slow to respond to the crash price. But anyway, so now the US is exporting, and as I say, last week we got our own. So, and there's the LNG price. Ugh, disaster. Disaster if you're a big company and you have just made billions of pounds of investment into LNG infrastructure. And nobody really thinks this market will sort itself out, will rebalance until mid-2020s. You've got to be an extremely big company to survive that. And, of course, there's the risk of more shale reserves being developed around the world. Doesn't seem to be happening at the moment for particular reasons, and if anybody wants to ask questions about that later, we can go into that. But that is a risk for anyone investing in gas at the moment. Many gas projects cancelled. This is the Stockman one up in the Arctic, a Russian project. Again, billions of pounds of assets just put aside. Can't do it. And just I've put this slide in just so that we don't forget that gas and oil, of course, is not just an economic issue, it's a political issue. 30% of Europe's gas comes from Russia. We've been really keen to get off it. Most of ours, of course, comes from Norway and from Qatar. But Eastern Europe is pretty much 100% dependent on gas. There's all sorts of political issues to do with this, about movements in gas and the price. So basically what happened in the US was that, having crashed their own price, what producers did was move to wet wells where they could. Okay, so where they could shift their production to oil or to natural gas liquids, they did so. And this is Mtoe in California. So they've been banging away at that and producing lots of oil. And in fact, this is the crucial bit. If the bottom line there, the light green is North America. And you can see the lift from about 2010. So really just the last 5 years, it's gone up by about 5 million. And this is really what has upset the world price. So that has had a really, really major effect. And just to add to the problems, there was already a glut because of Canadian tar sands. All the refineries are in the wrong place. They're all set up for imports rather than exports. It's been a fascinating story to read over the last few years about how America had to kind of suddenly get new transport facilities, new reserves, new reservoirs, and so on. And of course, the price has really tumbled here for the US oil. And actually, shall I just one of the reasons, I think this is really fascinating. One of the reasons why the US hasn't been able to just export is because they've had a ban on exporting oil. Yes, they can expand refined products, but not oil. And this is quite bizarre. This is leader of the free world. This is the country that goes around saying free trade everywhere, folks. You know, you don't get to trade with us unless you open up your borders and take down your barriers and so on. And yet they have refused to export their oil. And that was after the 1970s, after the oil shocks that we had then from the Iranian Revolution and the start of OPEC. And so Obama's been under a huge amount of pressure from the oil industry to allow exports and from the industrial lobby to not allow exports and to keep the price low in the US and to help their sort of economic recovery. So that's what's been going on over there. Now, again, the price is so low, massive pulling back of rigs and massive divestment from the thing. Same problem, many of these companies are absolutely up to their neck in debt. They have to keep drilling whatever. And so production has been very slow to decline. And truthfully, they've been very adaptable. I mean, surprisingly so. Everyone was predicting that US crude would really... shale crude would be over by the 2020s. And now I don't think anyone's making any bets on this. The industry has proved to be very, very nimble, very, very adaptable at bringing down their costs and keeping going. We have a little bit of new regulation. Obama has signed an agreement with Canada to cut methane emissions, methane being one of the main reasons why many of us oppose fracking, methane being so dangerous. And if this was to be implemented, it would cut about a third of the world's, it would be the equivalent of cutting about a third of the world's coal plants, make a major impact on our emissions. And of course, it's hitting legal challenges. From the API is the body that most of our big oil companies are signed up to, including British or European oil companies like BP, Shell and Total. So they're all objecting to this. Anyway, we've had a price crash, and I will go on to the details of that. Some of it is largely to do with shale, but there are many other factors bringing about this price crash. And so this has caused a massive divestment of projects around the world. Most of you will know, of course, that Shell has pulled out of the Arctic. This was after paying, I think, 6 or 7 billion. So if you're a shareholder in Shell, you should be asking about that. The same BP, the Liberty field, about $1 billion worth of investments just wiped off. This is tar sands. Again, massive withdrawal from tar sands in Canada, just write it off. North Sea, beginning of this year, North Sea has just collapsed, and we have sort of rigs lining up to be decommissioned. And Russia also exacerbated by sanctions. So lots of withdrawal of investment. So that is the current story that is the big story that's dominating oil and gas at the moment. And to be investable, these companies need to attract investment. They need to have shareholder investment. They need to be able to access the bond markets. They need to be able to access the banks. Because one of the surprising things is that I kind of naively thought, before I ever looked into this, that a bit like, when they were doing the railroads in the US, they would raise funds from willing shareholders and then go out and invest it and build railroads and so on. It's so much more complicated than that now, with our very complicated finance industry and so on. And these companies are highly leveraged. They don't use simply the funds they have, they use their status and their power and the funds they have to leverage more from the markets. So they are all quite indebted. And so basically, the things that make these companies investable are their access to reserves. They actually have to be able to prove they can get to oil or gas, and they have to be able to prove they've got access to finance. And this is what is causing them a whopping great headache at the moment. And both of these things are very much linked to price. So I'm actually going to, if it's okay with you, just walk you through some of the weirdest bits that I think a lot of people don't understand about how the oil price is fixed. And then we'll look at some of the bigger issues that face the industry. Okay, so the question is it just simply this oversupply? We've had, a 2%, less than 2% increase in supply. It's about 1 million barrels a day, and we use about 94 million barrels a day. So, it's a fairly marginal increase in supply, and yet we've seen a $60, $70 drop in price. It's kind of not in sync. So, of course, the truth is that there are many things that affect the oil price, and I'm just going to sort of trot you through a few of them. So what is Brent? You've heard of Brent, so it's often mentioned in the radio that it's the leading benchmark. And so that means that if you're in, Ethiopia and you want to buy oil from Saudi Arabia, there's probably a local benchmark, but it will be linked to Brent. Brent is the sort of leading benchmark around the world. And Brent is made up of Brent proper. These are different streams of oil. Oil is graded according to its sulfur content, so it can be low and sweet or high in sulfur. Have I got that around the wrong way? Low and whichever way. Anyway, so Brent proper, Forties, Osberg, and Ekofisk, and it's a basket of these four streams of oil, and you'd think that perhaps it would be the average, but it's not. The price is actually based on the lowest of those, which is usually Forties. Now the thing is that leads to an awful lot of disruption, squishing of the price around the wrong way. So for example, about a third of Forties comes from one platform, the Buzzer platform. In 2012, that was out of action after some routine maintenance. Whopped up the Brent oil price, which has an effect all around the world, simply because one rig is out of action for several months. In 2011, the UK signed a free trade agreement with South Korea, and it suddenly became profitable for the South Koreans to ship oil from the UK all the way around. I think it's a 45-day journey, each journey costing $4 to $6 million. But it became profitable for them to do that, and the stream of oil they wanted was Forties. So there was suddenly a big run on Forties. So you can see how it's very manipulable or easily manoeuvred, this Brent price. And of course now we've got such a crash in the North Sea. There are murmurings as to whether Brent will stay the leading benchmark, but it's hard to see what will take over from it at the moment. But you may say, of course, but don't OPEC control prices? We've all heard of OPEC, the Organisation of Petroleum Exporting Countries, and it's a cartel. And isn't this bizarre? There we are again, leaders of the free world, but we love this cartel, and we want them to work better as a cartel. We want them to control prices. So some sort of irony there. But 12 countries. And they work on a quota system. So they meet a couple of times a year and they agree between themselves how much oil they're going to put out. And the amount that they agree is very much dependent upon their own reserves. So Saudi Arabia has the biggest reserves, they're given the biggest quota, and so on. And so that's how they work. And you will have heard about Saudi Arabia as the sort of main villain of the piece when it comes to the current low oil price. And this isn't, as many people seem to believe, just because Saudi has upped its production. Saudi has a much more complicated role. It's the world swing producer, which means that whenever the oil price goes low, and therefore we need less, have I got this right? Less oil, we wheel them out and we need more oil. This right. We get Saudi Arabia to cut their production and vice versa. So, in fact, and I've actually met the guy who works in our Foreign Office, and it was his job to speak to Ali Al-Nami, who's the former oil minister of Saudi Arabia, and he'd sort of say, look, the market's getting jittery, the price is getting a bit low, can you just make an announcement you're going to do something on oil? And so out it would come. So there we go. That's how the oil prices has been largely controlled. But the big news was in 2014, Saudi Arabia said, no more. We're not prepared to do this anymore. We're not prepared to whop up our production and whop it down again. First of all, it damages their wells. That's not what they're saying, but that is the truth. You can't do this sort of swing stuff without really damaging your wells. And Saudi Arabia is very opaque. Nobody knows quite the state of their reserves. Certainly WikiLeaks in 2012 said that Saudi Arabia, the emails between various oil ministers and the US embassy there, said that Saudi would lose control of prices in 2012. And although, so the conventional argument, the argument you'll read in the press all the time at the moment, is that Saudi Arabia is making a bid for market share. So it's not prepared to control the price, it will let the price sink, and that means that high-cost producers like shale, in particular, will be eliminated. They've certainly eliminated the Arctic exploration at the moment. They're certainly making a big dent in tar sands. And that may sound reasonable. In the Middle East, oil is generally quite accessible and quite cheap to produce. While we've had high prices, our companies have gone into very, very expensive production, Arctic shale, ultra-deep water, and so on. And this is what Saudi and the OPEC countries are saying, you're just responsible for the oversupply. I have a theory that they, and this is just my personal theory, that they're actually saying we refuse to control prices, we won't act as swing producer anymore, because actually they've lost the ability to do so. And what they don't want is when they are next called upon to increase production, to say, well, actually we can't. We're struggling with our wells, or we can't to the extent that you want. So, and that is certainly what was expected from the WikiLeaks. But anyway, the convention on the market, Saudi Arabia has this kind of mythical status in the market. Saudi Arabia only has to come out and say, yes, we're going to increase production by 300,000 barrels a day, and the markets are calm, or we're going to cut, and the markets are calm. Nobody kind of waits to see what actually happens. But they've had this relationship with the West and this kind of really mythical status in the markets. And what I should say, of course, is that OPEC together produces about a third of the world's oil, about 30 million barrels, and of that, Saudi Arabia produces about a third, so about 10 million barrels. So they are the biggest producers. And, of course, you may know that last week, there was a meeting, an informal meeting. They're having their formal meeting in November. But finally, so many of the OPEC countries are suffering so badly with the low oil price. Even Saudi Arabia is. I mean, they've had to cut bonuses. They're issuing bonds. They're talking about selling a slice of their national oil company. It's amazing. Such wealthy countries, this oil price, they are so dependent upon oil that it is really hurting them. Nigeria, Venezuela, Angola, all in really big trouble. So they're all desperate to bring the oil price down. But, of course, nobody wants to be the one who cuts, because what they want to do is just keep producing, because that's how they can get more revenue. So nobody wants to be the one who cuts. And the question is whether the cartel will manage to... They've sort of come to a tentative agreement, but whether they actually manage to implement it and whether they actually manage to cut production, and then for that not simply to be compensated elsewhere in non-OPEC countries. So it's no good if OPEC cuts and suddenly Russia whops up their production, or, which is very likely, the US shale producers would just get back in there and start pumping away again. So, they're sort of saying, well, why should we do this, But somehow we need to do something on price. So, there we go. So there we are. You can see we are producing roughly around 1 million barrels a day more than demand at the moment. But, of course, demand and supply isn't the only issue, and as I've hinted, the markets themselves play a really big role in this. And it's really interesting to note how the markets have changed in the last 10, 15 years, really since about 2003, when China's industrialisation and liftoff really started to happen. And what it did was, let me just explain a market, first of all. This may be a little bit too basic, but obviously if I want to sell a bag of rice and you want to buy a bag of rice, we meet in the market. And these days we do it digitally, of course, but that's how it's done. And if there are 6 sellers and 6 buyers, that's great. It adds to liquidity, as they call it, and price discovery. That's the point of the markets. And anybody who works in the markets will tell you, this is what we're for. We're about price discovery. The trouble is, we've had this whopping, and I don't know if you can see it, this is just to one segment of the market, from almost nothing to $2.5 trillion in 14, 15 years. And basically, trillions of dollars have gone into commodities during this last period. This isn't about price discovery anymore. The markets, as everyone has heard them referred to, act like casinos. They are, it's a beauty contest. If I'm a trader and I hear that there's been a bomb blast in Sudan, I don't sit there and think, well, is that going to have a big impact on supply or demand? What I'm interested in is how my fellow traders are going to react. I'm not interested in the thing itself, I'm interested in how the rest of the market is going to react, and I need to be ahead of the game. So I need to lead that charge in selling or buying, whatever it is, because I think the price is going to go up or down. So it's become very, very, very herd-like. And in fact, actually, there's a good example today in the foreign exchange market, which of course is the biggest market. Tory party conference, Prime Minister May says something about, yes, Brexit really does mean Brexit. And suddenly the markets go haywire. Didn't we know that? There's no substantial difference to yesterday. But suddenly the pound has plummeted, shares up. The markets are... a little bit crazy, it seems. There are people who aren't interested in the asset at all. 99% of trades to do with oil and gas have nothing to do with oil and gas. They are not there. Those traders plan never to see a barrel of oil. They are trading in the derivatives that surround the oil and gas industry and all commodities. And if anybody wants me to explain that a little bit more another time, or in the Q&A, I can do that. And of course, actually, paradoxically, a lot of the money that has come into these markets actually comes from the oil-producing countries themselves. It's just a sort of side issue, but these countries have built up, you've probably heard of sovereign wealth funds. So rather than overload their own economies, they've had so much money rolling in during the 2000s, just money, money, money. And if you're a country like United Arab Emirates or whatever, well, you can buy so much bling and you can buy so many buildings and whatever and whatever. But in the end, it's just going to be inflationary in your own economy. So what they've done is they've put it into a separate fund. Now, of course, you're probably not going to bank it in the UAE or wherever. You bank it in the global north. So most of that money has travelled uphill into our banking system. It's a large part of the banking crisis of 2008 because our banks were awash with money and had to lend it somewhere. Where do they lend it? Subprime. They've lent it out to developing countries again, who are now all stuck with the debt that we thought we just freed them from with the Making Poverty history, and so on. And so it goes round. Anyway, So too much money is all I'm saying. Basically chasing too few goods. So weird thing. And of course, actually, folks, of course, you are involved in this. If you've got a pension or insurance, these funds, where will they be investing? They will be investing in these tracker funds in particular, which are very popular at the moment. And these are called the massive passives. They don't react to price. They are just literally tracking the FTSE 100. And they are betting long. They are betting on the price going up continually. So I'm not going to pretend to be a commodity trader or understand all the ins and outs, but I understand that this has been a massive push into really the price increases that we've seen over a while, and now the price decrease. So some of the things they crazily bet on are the difference between the price of the oil before it goes into the refinery and the price when it comes out. The difference between Brent and WTI, which is the US benchmark. Fun things to bet on. But the main thing that they've been focused on is, while we don't have it now, we have quite a slack market with this oversupply, but for crucial years in the late 2000s, we've had what they call a tight market, where demand and supply have been very closely aligned. And so what the market has been absolutely focused on is any possible supply disruption. Because if you lose 1 million barrels, price going up, you want to be there first, okay? So, we've had no end of potential supply disruptions. There's so many to think of. I mean, one of the ones that's been a particular focus point because of sanctions against Iran is the Straits of Hormuz, where 20% of the world's oil travels through that tiny gap every day. And when you think you've got a hostile country on one side, that doesn't bear well. And of course, the US Marines have been patrolling that forever, and I'm sure our Navy's probably involved in that too. Similarly, here we have the little straits, only 30 kilometres wide between Djibouti and Yemen, hot war in Yemen. But this is where most of our oil comes from to go up to through the Suez and into the Mediterranean. So, obvious potential for disruption there. Everyone wired for this. Nigeria, Libya, Iraqi, Kurdistan, Sudan, take your pick. Lots of potential for supply disruption, lots of potential for the markets to get excited. It only takes a rumour, a pipeline blast in Saudi. Wow, price goes zooming. So, of course, the other side is if there's a downturn in demand, that's the other thing. Oh my God, didn't the markets dread an agreement with Iran, a nuclear agreement with Iran? But that's what happened. More supply in Brazil. Every year the refineries go offline for maintenance. It causes, suddenly there's a lack of demand. And of course, with our slowing global economy, plenty of reduced demand. So all these have been issues. Every time new figures are published about China's growth or whatever, the markets react very quickly. Okay, and then this one, I think most people don't know about this, and I think it's a really, really weird one. The actual reporting of the Brent price is done by price reporting agencies. Now, these are completely non-transparent, and in fact, they say that their work is journalism, so you can't ask them who their sources are. What they will do, they'll have a conference call once a day, and they will ask a select group of traders, but they're not going to tell you who, and sometimes it can be as few as 5, what bids and offers and trades they've done that day. And then on the basis of that, they will confer with each other and they will come up with the benchmark. And that's what your exchange-traded fund will be based on. Okay, so this is a little bit like LIBOR. If anyone remembers LIBOR or followed that debate, this is very much like that. So, and I've put on here, this is Christophe de Margelis, who's now died, but he was the CEO of Total, and he was one of the few oil company chief execs to stand out and say, in our experience, the oil price often bears absolutely no reality to what's happening in our trading. And the point is that these are incredibly manipulable. If I want to buy a whole load of oil, a few million barrels of oil, okay, and send them off somewhere, I can make a speculative request about what price it would be to sell a whole bunch of oil. and thereby lower the, if that bid or if that suggestion is taken into the price reporting thing and makes part of benchmark, it'll bring the price down. I can then go back in at half an hour later and buy my oil at a much reduced price. So it's and to capital, Platts also have a trading arm, so a definite conflict of interest there. So basically, there came a point where the G20 said, look, actually, guys, you need to start telling us how you work, and this needs to become a little less opaque. And they all sort of said, well, if you do that, we'll go on strike, we won't work at all. And in which case, we wouldn't have had a functioning oil price, nobody could face that. So last thing I heard, our governments have backed down. Of course, these price reporting agencies are very much backed, Total aside, by all the major oil companies and by OPEC. They kind of like this system. Hard to tell why, because it is so non-transparent. But anyway, if you thought that this was, if you thought the price was all about supply and demand, it's not. It is more complicated than that, I suppose, is what I'm trying to tell you. And of course, as we've discussed, oil and gas are traded in dollars. You have to buy dollars before you buy your oil and gas. If you're Namibia, that's quite a tough challenge, particularly if your currency is very low and the dollar is very high. You're not going to be able to buy a lot. Quantitative easing has actually helped depress the dollar, and so that has actually made oil more affordable. So in fact, I saw one report which said it's actually quantitative easing that is keeping Brent above $30 at the moment. It has an effect. Okay, almost at the end of this section. I know what many of you will say is, yeah, but surely there's also these subsidies. We hear that oil is really subsidised, and surely that must be a factor in the oil pricing. It is, but it's more complicated than most people kind of assume. I've heard people sort of say they think that our governments sort of give cash injections to the oil companies. It doesn't work like that. A subsidy is really when the company isn't paying the full price for the work they do, for the thing they produce. And that would include decommissioning and so on. So not the full price. And what they're doing is, as an economist would say, they're externalising the costs. So they're focusing on exactly what they do, but the wider costs, they don't put on their books. Also, or the other way to do it is for governments to step in and artificially keep prices low to stimulate demand. And really, as far as I can see, it really depends on how you do the accountancy. I mean, if our government, funds the inquiry into a Heathrow extension, okay, we're paying for that. We taxpayers are paying for that. But who's going to benefit? Okay, the travel industry, the oil industry for sure. Airlines, manufacturers or builders or whatever. But it's not, so that's a kind of externalised cost. It's kind of a cost that comes to us. Every time our government builds roads and so on, it's actually effectively a subsidy to the oil industry. Okay, but we'll go back to the experts, the IMF, and in 2015 they published a report saying the oil and gas industry, the fossil fuel industries get around 5.3 trillion worth of subsidies every year. And I will just say that compares at that time to about 120 billion for renewables. So you can see the difference. And that's 10 minutes a day, 14.5 billion per 10 million a minute, 14.5 billion per day. And most of that goes to coal, but quite a sizable chunk goes to oil and also to gas. But only about 6% of those are overt price subsidies. So these are countries that, in Saudi Arabia, you would pay almost nothing to fill up your SUV, okay, because the government just subsidises it, okay, and that comes out of the public exchequer and so on. India, Indonesia, many developing countries, Nigeria, have had subsidies to keep prices low for the public. Now, you may think, particularly in countries like Nigeria, well, that's a great idea, isn't it? Because that makes energy affordable for the poor. The trouble is that it's very distorting. It puts a huge burden on the public exchequer. It tends to lead to a lot of smuggling, a lot of corruption, and generally it's the wealthier that benefits, all their diesel generators out the back. And so on. So anyway, 6% are these overt price subsidies. the IMF calculate the vast majority of subsidies are the externalised costs, mainly health issues and pollution issues, and that includes climate change. So, so these are things that do not arrive on the bill of the oil company. Does that make sense? And of course, in Europe, we have attempted to level the playing field with a emissions trading system so that carbon industries pay their full whack and levelise their price. But because of the financial crash, it just hasn't worked. Europe is awash with these almost worthless allowances, and they haven't been able to, for whatever reason, sort it out. The UK, of course, has put in a carbon floor, very good, under the Labour government, because the ETS wasn't working, we've actually got our own carbon price just for our country. I think at the moment it's about £18 a tonne, and that was supposed to escalate every year, but George Osborne froze it, and he's now under great pressure to withdraw it altogether. Take it out this autumn, in the autumn budget, that will be revealed whether he's going to take it out by about 2020, which will be a real shame because this is one of the things that has helped really kill off our coal industry in our country. So carbon taxing is something that we really, I think, need. But anyway, so subsidies are complicated is what I'm saying. But you will have heard, of course, there are some more overt headlines, and I've just picked out some headlines, some more overt subsidies, and I've just picked out some headlines from the FT. In January, when our North Sea was absolutely crashing, rigs just being laid to waste, David Cameron shot up to Aberdeen and said 250 million, which isn't a lot, actually, but more than you and I probably want to pay for a harbour expansion, for new research and development into new ways to exploit oil and gas. Really? I don't know. I mean, that wasn't long after he'd just signed up to full decarbonisation. Tax cuts, of course, is the major way that our government helps the North Sea oil, and they are doing that massively. We also give subsidies to the big energy users like steel, for example. And Shell is now asking, as are others, to be let off the decommissioning costs. And at the moment, the figures I've seen look like that will cost each of us about £1,000, which is quite extraordinary, to clean up the North Sea because the companies are going to be let off this. So, that's about the same as we will all be paying for Trident. So, there we go. OK, I think we'll stop there and we'll have a 10-minute break, and anybody who wants to ask any questions, we'll go for it now, and then the second part is much shorter. I'll just let you know. So, okay. So, oil companies are facing a variety of problems related to price, and basically, one of their most fundamental problems is their access to reserves. So oil companies obviously need to know they can get oil. And at the moment, we have about 50 years' worth of oil left around the world at the current price. Now, reserves are complicated because they are based on the technology available and the price. The industry argues that as the price goes up, more reserves will become available, and if the price goes down, the reverse will happen. But access to reserves is a real big issue for them. It's what shareholders invest in. When they invest in Shell or BP, what they want to know is that there are reserves there that the company has control of, and the assumption is that they will be more valuable tomorrow than they are today. That's been the basic premise behind the whole oil majors. And what they've had to do is it's what Rex Tillerson from ExxonMobil, he's the CEO of ExxonMobil, says, it's the one thing that keeps him awake at night, is access to reserves. And that is, actually we'll come on to the reasons for that in a minute. But basically we've had no major conventional, as in just bog standard, not shale, not tar sands, not ultra deep water, oil finds since the mid-2000s. So if you were wondering what happened to peak oil, shale happened, but peak oil hasn't really gone away in that sense. In the sense, we're sort of squeezing the pips at the moment to get our oil and gas out. And although there's plenty of oil there, it's very destructive, very energy intensive, and very expensive to get out. But the oil companies face other problems. They've had to go into more and more risky and high-cost areas. I mean, obviously, Deepwater Horizon, deep water in the Gulf, major disaster, 11 people dead. I think that's cost BP in the end 61 billion. But they got let off because it's tax deductible. So, in fact, they will only pay, I think, just 40 billion. So the rest of us will pay that. So, and in Aminas, I don't know if any of you remember the gas fields in Algeria a couple of years ago when there was a siege, and again there were many deaths, I think about 12 deaths, and it's not the kind of thing that oil companies want to go through many times. Nigeria, another example, many good examples of the oil industry having to work, or certainly our oil companies having to work in areas that are high cost and risky. Bizarrely, they've also been facing, over the last few years, the issue of an ageing workforce. I think the average age in the oil industry is something like 54. They've had real trouble attracting younger people. And they're getting more and more aggressive, antsy shareholders, which I hope is you, some of you. And now they're having to deal with the whole issue about carbon bubble, divestment, and legal challenges on what they've known about climate change and so on. And we'll sort of just work through those. So, in terms of reserves, as I was saying, really are a really crucial issue. And you may think that our big oil companies, I mean, ExxonMobil, they're the biggest listed company in the world, up there with Apple. Actually, it controls only that much. BP, that's fourth on the FTSE, only that much. Shell, here, if you can see it, very small amount. They're top of our FTSE index. So they actually control very, very few reserves. And as I say, this is what access to reserves is what makes companies investable. It's what shareholders want to see. And it's a bit like, it has been likened to asking the oil industry to fly higher and higher every year. So if they pump 4 million barrels a day, for example, as ExxonMobil probably does, they then, at the end of the year, have to have replaced all those reserves to stay investable. Does that make sense? And of course, actually, so who owns oil? So our oil companies, the big ones that we think rule the waves, actually control about less than 4% of the world's oil reserves. It's what we call the national oil companies that control the vast, vast majority. And the biggest one there is the National Iranian Oil Company, Saudi Arabia second, Gazprom in Russia, third one, and so on. And these are absolutely hated by liberal economists because they don't necessarily operate by liberal economic rules. They like to, their revenues generally go to the central government, so they don't have control of it usually over how much they invest. They're often used to employ people, so they're often seen as inefficient and corrupt. And of course, many of you will have read about Petrobras in Brazil, in the middle of a big corruption scandal. It's a little bit risky for our oil companies to point the finger and talk about corruption, however. But anyway, access to reserves is a real headache for our oil companies. And I would have to say, ExxonMobil, for example, before, they have not been good at this. Well, first of all, I would tell you that they have form when it comes to overstating reserves. Shell had a big legal case back in 2004. They'd overstated their reserves by about 23%. So misleading investors, misleading shareholders. ExxonMobil has kind of routinely done the same, but ExxonMobil is being investigated at the moment for overstating reserves. Just a headline I threw in because it was just very recent. I think it was a couple of months ago. Shell just had their headquarters raided because they'd by corruption investigators. This was to do with Nigerian reserves, getting access to those. So there's lots of dodgy dealing when it comes to getting reserves. And basically, our big companies have not been good at it. In what we call the sort of third scramble for Africa in the sort of 2000s, they've been left way behind. They were really focused on, while the oil price was high, they were focused on Arctic shale. Arctic tar sands and ultra deep water. The big macho high tech big investment projects. And it's these smaller ones, Tullow, Cairn, Anadarko, Hess, that have gone around Africa and started cleaning up Africa. This is Tony Hayward, who, of course, was sacked from, or had to leave BP after Deepwater Horizon, and he set up his own company and is now, or was working in Iraqi Kurdistan, but he's now had to leave because he can't make it work financially. Not to do with ISIS, but there we go. So the oil price, as I say, and you can see there, this is the Brent price since 2006. You can see that for several years we had a price above $100, and that's what encouraged our big six to go into such very expensive territory. I have to say, with shale, it's another one. They just didn't see it coming. We think these companies are so clever. And the joke is, of course, ExxonMobil has its headquarters in Texas. They were sitting on a shale basin, and they didn't get it. It was another company that came in and drilled and got it. And so all our companies were really forced to buy into shale at the height of the market. And in fact, for ExxonMobil, that was a lifesaver because their reserves were down to about 45% replacement. And by buying XTO at 41 billion, they whopped up their reserves again. So getting access to reserves is a tricky one, and basically our companies have not been good at it. Or when I say our company, I'm talking about the big super majors, as we call them. And here they are. They ExxonMobil, the biggest, and we. In fact, I think these figures are from last year. Their profits, Shell's profit, I think now is about half that. But what I found interesting, the reason I put this in, was because Shell's net debt at the moment is over 70 billion. BP's net debt is over 25 billion. I sort of found that fascinating, just because, hey, I don't work in the city. These figures are kind of new to me. I kind of thought these whopping great companies, as I say, sort of worked a bit out of revenue and all the rest of it. But they don't. They're highly, highly leveraged. And this is a real issue for them. Partly because of this, of course, the bit that we all know about. And this is surprising. It's come on the scene, the carbon bubble, the fact that we cannot drill the reserves we've got. We need to leave at least 80% of them in the ground. Of course, if we're going to go with the 1.5 target that was mooted in Paris, that brings that carbon budget down even further. So we have an awful lot of unburnable carbon, which means that these companies, they're investing all this money in finding new reserves and so on, that they can't drill. Okay? They can't drill. These are stranded assets. And of course, this is going to have implications for the financial system. And of course, actually, many of our heavyweights have weighed in there. Mark Carney, Governor of the Bank of England, is now saying, guys, you need to stress test for this because we don't understand how you're going to keep going. You cannot burn that carbon, so how is this going to work? You've got a massive debt, and these reserves are not going to be useful. Same with Lord Brown from BP, who, of course, did for a short while take BP into beyond petroleum and started investing in renewables and then had to leave, and that all got thrown out the window. Nick Stern, who has been a big advisor to our government on the finances of renewables and so on. Al Gore, the Pope, of course, and this is Fatih Birol from the International Energy Agency, all warning our companies that they are, this just doesn't make sense. And there are plenty of risk reports. This is just one, and a lot of it is about climate change. And so, okay, you think, oh, right, but these big companies, surely they're not going to take much notice. They're just going to carry on doing what they're going to do. Well, I think the gladdening thing is that the divestment move has actually made a big impact, actually, over a very short space of time. It started in a few US universities, and it's now really gained momentum. Of course, The Guardian in this country has been leading the fray here. But it's really taken off. And this is something that companies can't quite ignore anymore. Okay, so here we've got Stephen Rockefeller, who has said the Rockefeller Foundation will divest. And of course, this is a fund that is made was created from Standard Oil. And they have said that they will not only divest from fossil fuels, but they will positively invest in green
technology. The Norwegian Sovereign Wealth Fund has also said that they will divest from coal at the moment, and they're under pressure to divest further. But, of course, they are an oil fund themselves. Their money comes from the Norwegian national oil company, which is Statoil, and they very sensibly, over the years, have been putting their money into their sovereign wealth fund. Of course, we didn't. We put all ours into unemployment benefit back in the 80s, so we haven't got a sovereign wealth fund, but the Norwegians have, and it's a humongous one. It's the biggest in the world. It's around $900 billion. So absolutely huge. It has about 1 to 2% of almost every share of every European company that there is. But some people, I would just caution, because some people slightly mistake this, because this is an oil fund, it is built on oil wealth. They think that when the Norwegian oil fund is divesting, that they're pulling the whole 900 billion out. That's not the case. So only a small proportion, about 40 to 50 billion, is invested in oil and gas and coal, and they have said that at the moment they will pull some of it out of coal. But that's not 900 billion. So these banks have all been censured for their continuing to invest, and JP Morgan has finally said they won't invest in any new coal. So I just put them up there. Church of England, of course, has said they'll pull out their 12 million. It's kind of small fry. And I think last week we had the first pension fund, the first local authority pension fund, said they would divest. So, we're making strides, and it has an impact. And it's affecting those banks because, let's be clear, the oil industry and the banking system have a very, very close relationship. The oil companies have borrowed around 3 trillion over the last 10 years, and most of our banks at the moment are very overexposed to energy. Our banks aren't steady, aren't stable particularly, and it's not great news that they've got so much invested in energy. That's particularly true in the US, where many of the the American banks have invested in shale, gone hell for leather. But also a lot of the French banks in particular are very big investors in oil and gas. Actually, I will just tell you, I checked my pension fund last year, and it was supposedly an ethical fund with clerical and medical, and I found, and the top 4 criteria were all to do with environmental protection and so on. And what was the second biggest investment they made? Which company? It was EOG Resources, major US shale company. So if anybody, it's worth checking your pension, and even if you have an ethical pension, it's worth looking at where your investments are, because you are very likely to be invested in energy, and you may well be invested in shale without realising it. Okay, so basically the banks are now having to stress test and whatever, because what happens if everything goes pear-shaped with oil and gas? And coal, of course, is going bankrupt prolifically this year. We had some really major bankruptcies. So, the banks are looking a little bit shaky on this. And as I say, about 100 bankruptcies in the shale production in the US. So the trouble is that many of the investment funds will say, without big green funds to invest in, where do you want us to go? I saw a quote from CalPEPPers, which is the Californian public service pension scheme, and they have about 300 billion under management. Now, it's really hard. Where do they go to invest? Inevitably, they end up investing in energy. And the green investment side of things isn't robust and big enough to absorb that kind of investment. There are initiatives, they're coming along fast, Global Impact Investing Network. Merrill Lynch has set up a catalytic investment fund. Last week, I think a green bond index was launched in Luxembourg. But really, we need that to move very fast so that there is an alternative, so that when funds divest, there is somewhere positively for them to invest. Okay, so the oil and gas industries are also facing a lot more shareholder action. Shareholders having been very quiet for so many years, but now their demands not just on CEO pay, which has been a big issue, but also on climate change, pushing companies to disclose their climate risks and what they've known and so on, and how they're stress testing for climate change. And our companies are also facing legal challenges. The Philippine government, this was a major typhoon back in 2013. I think it killed over 6,000 people. And I think they estimate, it's something like 130 million, I may have that figure slightly wrong, but it's around there. It's way over 100 million have died from climate-related disasters in the recent past. And so the Philippine government is now looking to take BP, ExxonMobil and Shell to court for what they knew and what they haven't done. And of course the big one is ExxonMobil, the biggest oil company, independent oil company, and of course it is very clear now, we can see the documents. Back in the 1970s, their own scientific advisors were saying catastrophic climate change. You know, they used those words in a board meeting and the board did nothing. Okay, so now ExxonMobil is, they are facing serious legal challenges, and the risk for them is it's the nightmare scenario. It's tobacco companies, that individuals start going to prison for what they knew and what they didn't act on, and this is what they've dreaded for so long but thought would never happen. It may be that it is now happening. So there's an awful lot of headwinds facing the fossil fuel industries. Okay, so just looking at where they are now, what's the outlook for them? They're looking at lower for longer pricing. It's really not clear when oil and gas are going to come back into balance, when it's going to be profitable for them to be making serious investments again. And they don't just need the price to go up, they need the price to stay stable and up to make those big investments. And the other big question is peak demand. It's being talked about more and more. Are we seeing, at the moment the trend is that we will probably get to 100 million barrels a day, but fall off quite quickly from there. So it is very possible that demand itself will peak, and these companies that were so secure are going to have less so. And they also need to maintain investors' confidence, and it's really not clear they've got the confidence of the banks, who are looking dead shaky, having invested in them, and from shareholders. So, there we go. Okay, so the big question, what we really need to happen, this is the happy solution, isn't it? We've got these humongous companies that aren't going away, and we need massive investment in renewables and clean tech. So the ideal thing, no-brainer. We need big oil to turn green, don't we? We need them to start investing in solar, wind, hydrogen, whatever. And they've started to make very tentative toe in the water stuff. Total is the most committed. They've said 20% of renewables by 2040 in their portfolio. So that's, but of course that means 80% will still be conventional fossil fuels. Shell, again, they've set up a small new energies division, and they've joined a commission, and they've said yes, we will keep global warming below 2 degrees. But I think they said that on the same day that they said they still want to go back into the Arctic. So not terribly believable. BP, I think they had their Beyond Petroleum days 10 years ago, and now they're not looking at it anymore. ExxonMobil has said, we'll invest in some carbon capture and biofuels and so on. But it's really around the edges stuff. We need these companies to start really commit to a green agenda and start working with us rather than against us. But that's unlikely without more pressure. I mean, yes, they're making these slight moves, but as I say, oil groups are urging the US to leave the door open for Arctic drilling. Demand growth is still expected to rise. ExxonMobil may have cut its capital expenditure hugely by a quarter. That's slashing it. But that still means there's an awful lot left being invested, and that's the same for all of them. And Shell has just bought BG Group to increase its assets for 35 billion. It's coming from a lot of flack from its shareholders for doing that. A lot of questions. So there we go. So that's it. Okay. I mean, that's a really quick run through, and I hope that hangs together for you. This was sponsored by the Energy Co-op, and many thanks to them. So thank you.